Let's kick things off. So welcome. This is Talk by Loyal VC about investing like a poker player. And I'm Kamal Hassan. I'm one of the managing partners of Loyal VC. We're a 3.5-year-old venture fund launched in 2018. My own background is I've been an entrepreneur for about 20 years, 15 years of that angel investing, also a consultant at Bain & Company where I spent some time looking at microfinance. And I was a director of the Founder Institute, an accelerator program. And over the past, 10 years or so, I've advised over, I think it's up to 500 companies right now who I've advised. So I've run into a lot of different companies, entrepreneurs, and heard a lot of stories from different entrepreneurs about investing. And over the 20 years, done a lot of thinking about what I'd like to see, what I would like to see as an entrepreneur from investors, and done a lot of thinking about how money is made. Michael Kosick, my co-founder of Loyal, is on the call. Michael, do you want to say 30 seconds about yourself?
Sure. So lifelong entrepreneur, industrial engineer by first degree, INSEAD MBA by second. And Kamal and I have worked together in a variety of capacities over the years, including on the alumni executive for INSEAD, together at a startup. We built a fund that does things a little bit differently. We think maybe a little bit better, and a fund that we would want to take money from as entrepreneurs and wants to invest in as angels.
In terms of the fund itself, so there's three things that set Loyal VC apart. We always tell people. The first is this investing style, this investing strategy we use, which is, call it a poker investing strategy, and we'll get into it in more detail. Our returns have been excellent. We have top quartile returns since we launched. We're also a very diversified fund, and it's an open-ended fund. And we won't talk a lot about that and why we do it, et cetera, other than to say Sequoia adopted the same structure recently, which was quite exciting for us. But let's really start off with the investing philosophy, what we do, what this poker investing strategy is, which seems to have been quite financially profitable for us. The core question and the philosophy around poker style investing is to ask the question of, can VCs predict the future? And most people who invest in venture capitalists, the LPs or limited partners, would say, absolutely yes. And VCs will show up at your front door and they'll give all sorts of reasons for why they can predict the future. They've got deep expertise in specific industries. They can see how the economy is developing. They can see emerging trends, which they're going after. They're screening over 100 deals, many of them 200 deals for every one they select. So clearly they can sort of predict the future. And in fact, pretty well every VC that's ever been funded by a major limited partner and institution has a proven track record of success. So there really is this image in the industry that VCs are able to predict the future. The thing is, when you look at the actual numbers, the results industry-wide are very, very humbling. Now, when VCs invest, they're picking only the best one in 100 or 1 in 200 deals. So they're only investing in companies which they think are a likely home run, giving them 10 times their money back or more. Yet, if you look at the reality, only 4% of VC deals actually ever give 10 times their money back or more. The bulk of them do worse than that, with 2/3 of deals failing. So if venture capitalists are good at predicting the future, these are pretty horrible results. By the way, why do people even invest in venture capital with these results? Well, they invest in venture capital because the math still works, even with these probabilities. So if you look at those 65% of deals that fail, and you get back around 0.1 times your money at the end of that investment, there's 0.07 times your money back from the fund as a whole. The next 31% of the deals in here give you an average of around 3 times your money back. So there is 0.93 times your money back. So you can see from this initial 96% of your deals, you're getting your money back. Why do people invest in VC? It's because of this last 4%, these home runs. And if you get, say, and this becomes very arbitrary, but if you get, say, 25 times your money on your home runs, you get 1 times your money back. If you get 50 times your money on your home runs, you get 2 times your money back there. But you can see just basic normal venture capital, you should expect to double your money over a period of multiple years, and it could very well be triple your money or more, depending very much on the home runs. So this is the industry-wide numbers. Let's actually give you one specific example also of how VCs aren't necessarily doing a great job of investing in winners. And this is from Bessemer Venture Partners. Now, Bessemer Venture Partners, probably the oldest VC in the US, one of the top VCs in the world. And they have their anti-portfolio on their website, which is a list of companies they passed on and the reasons for doing so. So they have passed on Apple, Google, Zoom, Tesla, Coinbase, Facebook, PayPal, and they often have very good, very logical reasons for doing so. So for instance, for Facebook, when they heard the pitch, they said back, hey kid, haven't you heard of Friendster? Move on, it's over. For PayPal, they looked at it and said, look, this is a rookie team. It's a regulatory nightmare. Forget it. So there's very logical things going on. So when you're looking at some of the smartest VCs in the world, they also have some challenges, which leads us to a fundamental question about what kind of activity is angel investing and VC. Is this an activity which is like cooking, where you can predict the future, you have predictable outcomes? You say, if you have an entrepreneur like this, and they're doing this in this industry, and they're doing these things, then therefore we give them money and we have an outcome which we can know and predict. There's a recipe, you follow the recipe, and if you follow the recipe, you will make money knowing these inputs. You will get money out the other end. Or is venture and angel investing more like poker? And let's talk a little bit about poker here. I'm not sure how many of you have experience with poker, but the basic concept with poker is to say you have an unpredictable outcome which becomes revealed over time. And the way, for those who play Texas Hold'em, you start off with 2 cards, which are your cards that you see nobody else does. And then you have a flop, a draw, and a river where 3 cards are revealed, then another card, and finally the last card. And you end up, people who play against each other are going to be making the best set of 5 cards that they can. So the thing about poker is it is completely unpredictable. If you start off with these 3 hands here, you would look at this and say, hey, I have a pair of aces. This pair of aces is a really good hand. It's the strongest pair you can get. A 7-4 looks ridiculously weak, and a queen jack, okay, that's nice, and they're both hearts, and that's nice, but the double aces is by far the strongest hand. What happens over time when you flip, say, these first 3 cards, the double aces, the best 5 cards is still, here are the double aces, and there's a 3, 4, 5, 7 here, gee, that's nice, and there's a pair of jacks here, that's nice, but it's not as big as a pair of aces. As things happen over time, you flip a 6 there, and all of a sudden, this person here is a 3, 4, 5, 6, 7. They've got 5 cards in a row, which definitely beats the 2 aces. And in fact, it even beats 3 aces. So things can surprise you. Things can turn out not the way you expect. And in fact, by the time that 5th card is flipped, yes, this person is a 3, 4, 5, 6, 7, a straight, which is better than the 3 aces. But this 3rd person ends up now with 5 hearts, and 5 hearts is actually, a flush is actually higher than a straight. So you can see things change, things evolve over time. And if you're looking at how to bet on these different hands, fundamentally, this is the question. Is the future unpredictable, where you don't know what's going to happen? And if you don't know what's going to happen, and it's a probability game, then you really need to say, how should I invest? And there's a lot of good lessons from poker because that's what poker is all about. Poker is all about making money based on probability of outcomes with uncertain futures, which are revealed over time. And that's really one of the things which has inspired Loyal, is to say, this is how we philosophically, how we think about investing. You can't say that it's completely blind. You have at least some skill that you can use, but it is something which looks much more like poker, where you don't know what's going to happen, than cooking, where the outcome is predictable. If you actually, another way of thinking of this data in this industry is to think about false negatives and false positives. Most of the industry is very focused on minimizing false positives. Don't invest money in companies which are going to fail. And yet 2/3 of the companies fail. But the whole process, the standard way of looking in VC, is to say, find reasons to say no. I can forecast what the future is going to be. This is the traditional view, and we're only going to pick 1 out of every 100 deals we look at, or 1 out of every 200 deals. And in poker equivalent, this would be the same as saying, hey, I'm going to fold everything unless I hold a pair of aces or a pair of kings. I'm just going to only play the hands which up front look like the very best hands, and that's all I'm going to do, and I'm just going to fold everything else. I won't even look at it. The alternative view is to think about minimizing false negatives. You want to avoid not investing in Facebook when you have the chance. You want to be able to have someone in there. And in poker terms, this is really saying you should play a wide range of hands. Put the antes in, see a whole bunch of hands so you can see what's going on. And if you like them, we'll play a relatively wide range of hands to at least see how the deal develops over time. Now, there was an interesting study by the head of data science at AngelList, who published it in Kaufman Fellows back in December 2019. They looked at all of the deals that showed up on the AngelList platform, and they did sort of a statistical analysis. And they said, what is the smartest investing strategy out of all these, in their case, literally millions of deals that they've seen on their platform? And the outcome they found from that analysis was that seed stage investors, so this is investing at the early stages when companies' futures are still uncertain, is that seed stage investors should put money into every credible deal. Now, a credible deal just means the deal has a chance of succeeding, et cetera. But as they point out, the tricky part of the math was assessing whether a deal is credible or not. It's challenging. Futures are unpredictable. But still, that's a very different problem to solve, to say, is a deal credible, rather than is a deal the 1 in 100? And if you're looking for credible deals, you'll end up picking 30 or 50 out of 100. You'll get rid of all the crap, but you will be picking a large number of deals here. And this is really the strategy they found that worked. And in fact, they said over a 10-year investment window, indexing, i.e. funding everything, beats 90 to 95% of investors picking deals. Now, that is a shocking assumption. It also says that, hey, we should be really thinking about this in terms of playing a large number of hands. The mathematical reason for this, the reason why indexing outperforms, is you need to look at this very right-hand side. You've got around 1% of all deals, which are really amazing outliers, 20 times, 50 times or more on your money back. And the thing is, if you have a larger portfolio, if you invest in more companies, or as AngelList says it, invest in everything, your chances are that you're going to include everything, including these very rare mega winners. The more you try to pick and score and say, hey, I'm only going to put money into a few deals, even if you're very good at picking deals, there's still a large probability that you're going to miss out on these mega winners. And as we've seen in venture capital math, it's those mega winners which drive the bulk of your returns. So doing more deals gives you exposure to more things. Playing more poker hands to the flop gives you the chance of all of a sudden you can get that flush, you can get that straight, which looks very improbable when you looked at your starting hand. So this is, yeah, but this is the fundamentally, hey, index, do a lot of investing. This is one of the reasons Loyal diversifies. And in fact, if you look at our funds so far, we've got over 210 deals right now, and it's actually now over 50 countries. And we're diversified by sector, but this is a big part of the philosophy we have, is to say, well, we can't predict the future. Yes, blockchain is part of our portfolio, is 8%. But is blockchain going to outperform? Is health going to outperform? And health has looked very strong in the past 2 years. We invested in a RNA, a company run by one of the top RNA virologists in the world in 2019. And in 2019, RNA viruses were not a hot topic. Now they are, surprise, surprise. But things evolve over time. Food and ag tech was considered a sort of a scary thing for a long time. But this really comes back to is investing predictable? And if investing isn't predictable, I mean, look at where we've just spent 2 years, we're emerging from a global pandemic. That pandemic was not really a fully predictable event. I mean, people would have told you in the industry, you know, I've been hearing rumors for decades of, hey, there's a risk of global pandemics. We haven't had one for a long time. Epidemiologists said this risk is out there. But really this belief that the world is not predictable causes you to invest in a series of different industries because you're not sure which ones will come out in a series of different countries. I know many people in the venture capital space who focus 80 to 100% of their money into just the core markets in the US of Silicon Valley, New York, maybe London if they're going to go to Europe, because that's where the past successes have all come from. This, again, is using the past to predict the future. Again, is saying things are predictable. And we really question that and say, if the future is not predictable, invest accordingly, diversify, have a little bit in different things. Now, here is our dirty secret. Here is, if you ever wanted to copy Loyal, I can tell you exactly how we invest, because we follow very strict formulaic investments. We do start every investment with a pilot. Our goal is to say, hey, if you are a poker player, this $10,000 pilot is like your ante. You put in money, ante or blinds, depending how you're playing. You put in your ante or blinds. You're basically paying money for the price of getting into the game to see your hands. And what we do with this $10,000 investment is it allows us to learn a lot about many different companies. Now you can see the amount of money deployed here is tiny relative to the amount of money we deploy later. Just like in poker, your ante is tiny compared to the amounts you bet on later rounds, but it is that ante which gives you access to hands to play from. We do 6 investments every month at this $10,000 stage. The top third of those companies, so that is 2 every month, move on and get $200,000. Now that is, if you run the math, I mean, it seems pretty simple. 1 out of 3 goes on. We'll have 70 go on of those 210. We've done 56 of them so far. On the one hand, the odds sound very simple. It's like 1 in 3 goes on. On the other hand, if you actually look at the fact that there is a delay of 10 months between the pilot and the proven stage, we actually are currently running with almost 100 active pilot investments. So those are companies which have not failed yet, and they also haven't gone on to the next stage. They're in that in-between stage being evaluated. So when we pick 2 companies a month to invest in, we're picking the top 2 out of 100 companies. But we're doing this within companies we've got a relationship with, companies who we've gotten to know over time, where we have an information advantage, where we have a relationship advantage, where we can act quicker than any other investor, where we've pre-qualified them. The top third of those, so that's 2 every quarter, move on to $1 million investment. And we intend to continue this. As you can see, we're three years old and things take time to move through the cycles. The poker, you can think of this first investment as the ante. If we talk now more in investing terms, these follow-on investments really are where we diversify the capital across a whole bunch of proven opportunities, which we checked out in a pilot, and then we focus money into a smaller few to drive returns. We are still ourselves forecasting the future a bit, but we're just like poker players forecast the future a bit after they see the flop. They don't know how it's going to turn out, but they've got a really good idea already from their initial hands, plus what they've seen develop over time. So we're basically putting our thumb on the scales to give ourselves a higher probability of making money on the much larger follow-on investments. But we still don't know how it's going to turn out. Things are still unpredictable, and that last card can surprise you and turn a winning hand into a losing one. But this is really Loyal's philosophy, is to say, look, fundamentally, what kind of activity is investing? And we believe it is not like cooking where there's a recipe which gives you predictable outcomes, but it really is something where the outcomes are unpredictable. But those are unpredictable outcomes which are known at the very end, within 10 years, 12 years, however long it takes. Retrospectively, you will know how a company turned out. And really, it's a case of not just sort of saying, here I am today, and have to guess what that outcome is, but I will watch things develop over time, invest amounts of money over time as that future gets revealed, and I can see my probabilities changing and invest more where those probabilities are looking interesting and good to me. But admit that I still don't know what's going to happen. I still don't know that, hey, I'm so excited that on the turn I've got a straight, but on the turn that straight is still going to lose out to the flush on the river. You never know how things are going to turn out. But play it this way, play the odds. And professional poker players are great at this, where they know the probability of the different cards which are out there, depending where you're sitting, how people have bet. They're always playing probabilities over time. And that's really what we're doing. Gather data, gather information, play the probabilities, have these small antes so you at least know what's going on in detail in the number of cards, and just play those probabilities over time. So there we are. That is the introduction to investing like a poker player. And let's throw it open now to people for questions, comments, discussion. Just as a quick question while I'm waiting here, I'm curious if there's anyone on the call today who does play poker, if this is something they do. Okay. Absolutely. Mike is a passionate poker player for sure. Niti, you play poker?
I do, but perhaps not as much as Michael.
We'll have to play someday, Niti. That'll be fun.
I've played with this ladies poker group in Toronto that would meet once a quarter, and that's how I learned a bit. And it's now I understand better. That was really good, Kamel and Michael. That was I really enjoyed this presentation. Definitely need to get the word out on this one.
Excellent. Yeah, no, it's interesting. I mean, it's actually really hard to admit to yourself that you don't know how companies are going to turn out. And it's really challenging to invest in that environment of being fully aware of your own human frailty, and that all you can ever do is make guesses playing the odds. And that's the whole point of poker, is if you only play a few hands, first of all, you're unlikely to see good hands. If you only play a few hands, you'll get a couple of good hands and a bunch of bad ones. but you've got to play. If you play a lot of hands well, a professional poker player will on average make money over time because they're always playing the odds. They always know the odds. And that's really what it is this is an industry, we believe, about systematically playing the odds, setting things up to understand the odds, rather than saying, no, I have this secret formula which says, I know that this person's going to succeed.
And the interesting thing is Loyal is an open-ended fund. It's a forever fund, put differently. So if this was all about just the brilliant predictions and magical foresight of the founders, that would disappear after they pass. What we have built here and has been working since inception is a process that seems to be systematically generating these returns. So that's what we're committed to.
And it's just really putting yourself in a position to have a investment advantage compared to everyone else, because given the pilot investment, you know the company more than everyone else. In poker terms, you actually know your hand and everyone else is playing blind. You're playing a hand you know against people who are playing without knowing their hand. So it's, yeah, so that's really, you get that information advantage. And we don't talk about this a lot, but the other massive thing the early investments give you, and this is not a poker analogy, is they give you an access advantage. So we have, when we see a company doing well, we can react quicker than any other investor. And I mean, a classic story is the entrepreneur sits down, they focus really hard on their business. They double their sales over a 2-month period. And we say to them, wow, you've doubled your sales over a 2-month period. This really seems to be working. Would you like an investment? And the entrepreneur replies, gee, yes, I'd love some money. I was planning to go out and pull a deck together and raise money from other people. But if you'll give me money right now, I don't have to do that. And I'll just take the money and keep growing my business. Because most investors don't think about the fact that fundraising is very time consuming for entrepreneurs. In fact, just preparing a pitch deck, and everyone wants to see a pitch deck, is going to take you multiple weeks to get it worked up, to pitch back and forth, practiced. And that takes time out of your business. So a big chunk of what we do is those pilots put us in a position to systematically be able to out invest. And then we just have to be good, friendly, useful people who deliver value. So they say yes when we make offers. And we have a 98% acceptance rate on our offers to pilot companies for the next round, which is, I mean, find us a VC out there with a 98% acceptance rate. Often it isn't. Investing isn't rocket science. It isn't brilliance. When you see a company whose sales are growing quickly, you go, hey, you're doing something right. And over half of our investments are that. So over half our investments are just great sales data. And we're in a position where either we know and other people don't, or we make an offer before anyone else does. And it's just that sort of access advantage is what drives a big chunk of our returns.
Kamal, there's a good question there from Jose in the chat. Was asking, when you expand the funnel to early stage startups, instead of having to deal with some of the founders, now you have to deal with 210 in your portfolio. How difficult is it to manage, to get to know, advise, and assess this large number of startups? And how will Loyal scale to even more startups than that? Great
question, Jose Miguel. This is systematically, and actually I will go find a slide here, because we do have a slide which answers that question in detail.
While Kamal is digging that up, it's a combination of process and people. So as he's digging that up, let me first say, I would rather have 10 half-an-hour meetings than one 5-hour meeting. And 10 half-an-hour meetings over 10 months will give you a lot more information. So it's not necessarily about the duration, it's more about the intensity. Go ahead, Kamal.
Yeah. This is a slide we actually use to share in terms of how we spend our time as partners. And this is the split between supporting our existing portfolio. sourcing, which is finding the new companies, and then other activities to support the company operations, fundraising. This little thing down here in the bottom right shows you what the industry average is. So most VCs will spend, call it 40% of their time, actually call it 35% of their time supporting their company and 35% of their time on sourcing. Sourcing is going to pitches, going to mingling events, meeting entrepreneurs they've never met before, and trying to identify those diamonds in the rough who are going to be the 1 in 100 or 1 in 200. Because remember, you need to put a whole bunch of companies into your funnel to evaluate. If you're going to pick 1 in 100, you need to find 100 to look at. What Loyal does is we actually don't spend all this time looking for deals. We have partnerships set up with the Founder Institute and alumni of the INSEAD Business School to really help funnel companies to us quickly and efficiently. And we spend very little time screening them. And we probably invest, Founder Institute pre-screens for us. And INSEAD is pre-screening as well in a way. And out of the INSEAD companies, we'll probably invest in 1 out of every 2 that we see. So there's a very light filter, which takes very little time to just filter out the plausible deals from the not so plausible ones. And then so we gain a lot of time by not wasting all this time on sourcing, on talking to companies you'll never talk to again. And we focus that time on supporting our companies. And then to Michael's point, systematically, it's a half hour per company per month. And when the company needs more help, we have a network of 500 advisors around the world. So we say, sure, I could help advise you on your digital marketing, but I happen to know Cole, who does digital marketing for a living and who's one of our advisors, and could tell you more about digital marketing than I've ever learned. And whether it's digital marketing, pricing, product, pitch decks, you name it, we have people who are experts on it. So really our job as an investor is almost more to be a traffic cop. And if you don't spend as much time personally supporting the companies because you have people who can support them better than you can, and you funnel them out to that network, which by the way is exactly what accelerators do. We're not doing anything new here. We're just copying what accelerators do. But that's how accelerators support. That's how we support. That gives us the extra time. And you can see a half hour per company per month. That actually works out to over 200 companies. That's 100 hours split across 2 full-time people and 10 one-day-a-week venture partners. So the equivalent of 4 people. That's the equivalent of about 25 hours a month of support, which is pretty reasonable. James, yes, we are recording this, so we can share that with you. Question from Rahul here, who says, if one were to deploy this investment strategy 10 years ago, what would the outcome look like, or how would it differ? Where deals were a lot less competitive, et cetera. Rahul, it's a great question. When we initially set this strategy up, we did some modeling, and our initial modeling said, this would have worked. What's shocking is that this strategy has worked pretty well exactly to plan as modeled. The thing which is stunning us right now, and we are flabbergasted by this, we still don't believe it ourselves, is our 98% acceptance rate. Now, we believed that we would have about a 50% acceptance rate in today's market where deals are incredibly competitive. What we are seeing our founders do is they are saying things to us like, my deal is oversubscribed, but you were with me from the beginning. You've been so helpful that if you want to get into this round, I will make room for you, and I will squeeze out or reduce the allocation to other people to give you your allocation. So we are seeing that type of thing happen, which we did not expect. So what would I expect? I would have expected our returns to be lower than they are. And when I say returns to be lower than they are, I mean, we've had really good returns. So lower than they are would have meant just good returns rather than really good returns. But we would have expected to lose deals. We'd have expected to lose deals because the market is so competitive. We are right now, one of the things we do see happening right now in the market is there are deals we're passing on, not because we don't like the company, not because we don't think it has a good potential in the future, but because the deal is too expensive. We think given the risk-adjusted probability of the returns from this specific deal, and we compare it to another deal we have, and this is the advantage of being global. Often we're finding in Silicon Valley, the prices are higher, the valuations are very high, and we're investing instead in Egypt, Nigeria, Bulgaria, Thailand, whatever it is, Australia, where we're seeing more reasonable valuations. And then we get the Australian company, which gets into Y Combinator, and they hit across to the US and they go to Y Combinator, and they're starting to get Y Combinator valuations. And we think, good company, but at that valuation, not sure we would do that investment. Yeah, this strategy is a strategy which should work. If anything, you'd expect the strategy to work less well in a hyper-competitive environment like we have today. And so far, it's been working shockingly well. But let's see. We'll see how it develops over time. Yi-Lee's got a question here. Says, compared to cards on hand in poker game to place the initial bet, what are the most important elements to decide on the pilot investment in deals? Experience of the founder, business plan, or general picture of the industry? Yi-Lee, we are really big believers in evaluating people based on what they do and what they've done. So 55% of our deals come from the Founder Institute. The Founder Institute runs a 4-month accelerator program where people have assignments to complete every week in building their business. And it's just a series of things you need to do. You need to find customers, interview customers, sign up customers, build product, get team members, et cetera, et cetera. And they just give you assignments to do every week. And they'll start off with 40 people in the program. And at the end of 4 months, they'll have about 15 people left or 10 people left. And we go to the director who ran the program and we said, you've watched people deliver every week for the past 4 months. Who do you think is best? We actually don't use pitch decks. We don't like to listen to pitches. And one of the reasons why is there's actually some really good studies out there from Harvard which show that if you take an identical pitch is delivered by a good-looking man, a bad-looking man, a bad-looking woman, or a good-looking woman, in that order is how they will be funded with an identical pitch and an identical script. People are more likely in a quick gut reaction to give money to good-looking men than everyone else, and least likely to give it to women. And the thing is, if you fund based on pitches, science says, the results say that we are biased, whatever the reasons. Whereas when you fund people based on results, and there are a few funds, including Loyal, and we try to work this into our processes, who fund based on what you do, not what you say. And when you look at funding people based on what they actually do, funds that do that tend to have, well, they have 10 times the industry average of women funded, which means 30 to 40% of women funded rather than 3% women funded. But that is, so we're not big believers in pitch decks. And when you look at past experience of the founder, there's actually some good science out there, which says a previously successful founder is slightly more likely to not fail. So if on average 65% of companies fail, I think the number with previously 65% fail, i.e. only 35% succeed. I think the average is at something like 40% rather than 35% with previously experienced founders. So yeah, I mean, it's previously experienced founders doesn't make a big difference. I mean, what do we look at? We look at progress, we look at what they do. And one important element we actually look at, which may surprise some people, is we look at if the founder goes full time. Because we figure if it's a smart person where the deal has been screened as unlikely to fail, and just being an INSEAD grad, doing something which seems reasonable as a deal, so they're unlikely to fail, then we'll give them a chance. We'll put a small amount of money in it to see what happens. But it is a very different thinking. You're thinking, how do you find plausible deals, not will this succeed? And if someone works hard, makes progress, looks like they have a chance, try them out and see what goes on.
There's another question in the chat box which says, what are the matrices that you use to evaluate for moving the companies from pilot to proven stage? And how do you compare those startups, because they are in completely different spaces, B2B, B2C, maybe non-revenue, but heavy on R&D?
So let me tell you, we went and we studied our companies and we said, why did we make the investment? So this isn't the arguments we used to make it. We looked back in retrospect and said, out of all the follow-on investments we've made, why did we do it? And you can see here, 60% of the time, it was based off of just pure revenue. It was either B2C revenue, sort of revenue growth directly, or it was B2B sales success. For instance, signing large key accounts, which may not yet have revenue, which revenue may take a while to come from, but you could see from the account. It's like we had a company in Thailand which does organic food, which 4 days after they'd signed a deal with Whole Foods to be on 80% of the store shelves across the US, we offered them more money. Pretty simple, even though the revenue still hadn't gone up, but that contract was clearly going to bring revenue within a 4 to 6 month lag. So 2/3 of the time it's that. Then we have 15, 20% of the time, which is non-sales metrics. So it's things like engagement. If you look at Facebook, for instance, if you had looked in detail at Facebook's engagement numbers early on and how much people were using the platform, you would have seen something really exciting in that business, even though the sales weren't there yet. You would say if people vote with their time, there's going to be money to be made from this at some point. Some of it's based on technology success, exceptional tech, which is validated typically in a customer demo. Sometimes it's steady progress. The actual way we do it is we do group.
May I have your number? We can chat later. Yeah.
Sorry, someone's talking there in the back.
Okay, up to you. If you want. Yeah.
All right.
No? Okay, sure. Okay, they look really good, yeah.
Okay, there, I think we've caught them. If you look at what the actual process we use sort of, there's some good science out about how many people's opinions together are better than just 1 or 2 people's opinions. So we have a 12-person, 13-person investment committee who meet once a month to discuss all of the companies. We have a lead on the company who speaks to them 2 months out of 3. And the 3rd month, we have someone else from the committee talks to them. So when we sit down in that investment committee, we have multiple people comparing different companies together. We have multiple points of view on every company. And we're sitting there as a team saying, let's rank these companies together, and we'll rank them, and we'll end up with sort of a short list of around 8 companies that we're trying to pick the top 2 from. And we had a horrible month last month because we had about 16 of them, and we're sitting there going, how do you pick the top 2 out of 16? This is really tough. But then it's an iterative discussion process where people make cases, where we challenge the decisions, and we try as a group to really come up with what is the best overall decision. So that's what we actually do, is we make those overall decisions, and we'll start questioning ourselves, and different people bring up different points of view to challenge us to try to make the best decision. So that's the actual process we use, is a bunch of human intelligence based on deep insight of these companies. There's a question from Amin here. In poker, people are always trying to beat the house using different models, strategies, probability theories, etc. keeping that in mind, I know of a few companies trying to develop a platform to automate VC investing using their data on prior deals, et cetera. I've been skeptical of the success of this, as early stage investing can tend to be more qualitative, but do you think it's something that could work to beat the house and pick up an interest from more investors? This is absolutely something which people have been really excited by. And I absolutely agree, it's worth having that data. Fundamentally, I think there's a lot of limits to the classical gather a bunch of data, make a one-time investing decision of the VC model. And this comes back to, is the future predictable or not? Because fundamentally, you're saying there should be a recipe here. If we can get all the ingredients together, there should be a recipe which says, if we do this, then the company will succeed. And we fundamentally believe the future is unpredictable. There's a large element of luck. There was actually an interesting study out recently, which was looking at, they used this for astronauts, I believe, and they were looking at the candidates of people who became NASA astronauts. And just like in VC, 1 out of every 100 or 1 out of every 200 candidates will become NASA astronauts. And they looked at sort of their list of their skills, and they modeled out based on, here are the skills, and should the most skilled person become the astronaut? And then they tossed in an element of luck. And what they found is, with even some luck involved, if you look at who the top 10 astronauts were out of a pool of 1,000, only it was 1.6 of those would have been in the top 10 if luck were not a factor. So if you add like a 20% luck factor, luck becomes a very important element of those top 10 people. So it fundamentally, if you think the future is unpredictable, i.e. luck matters, well, you can't predict luck, because luck is not an inherent part of a strategy. It's not an inherent feature a person has. You just happen to be in the right place at the right time. So we actually think it makes a lot more sense to invest over time, where you can react to luck as it happens, rather than just coming in with all the bets at the beginning. And so we fundamentally do think it's a lot like poker, which is, we saw the example I gave you where the person drew the straight, and sort of the odds of drawing this 3, 4, 5, 6, 7 in the straight on the second last card were amazing. And yet they still lost the hand to someone else who came in there. And you can't, I mean, you're lucky, you're unlucky. That's the biggest thing you learn in poker, is that you will do everything right and still lose a hand because the luck was against you. And we really believe that you have to invest the same way. So see how luck develops, put small amounts in. We've got a company in our portfolio where the woman is doing software for multi-location businesses to manage all their locations. Sounds incredibly general and incredibly crazy. I can make it simpler by saying it's for retailers to manage every part of their retail locations other than their stock and their sales. It's multi-feature software. So first of all, you look at them and say, you don't have a hope. Surely somebody does this already. You're competing against SAP, forget it. No one's going to buy your software. This was started up by a woman who was like a 26-year-old Russian immigrant who'd been working for a couple of years with retailers, helping to manage all their locations, and said, here's stuff they don't do. We need this software. She went through 3 different CTOs, in turn, trying to build this crazy multi-feature software, and could never find a CEO to work with. And clearly, after the 3rd CTO was lost, you think there's something wrong with her. And yet, if you look at how that business is developed against all the odds, I mean, you look at this person, 26-year-old recent immigrant with 2 years work experience as a user who knows the problem, and that's it. Cannot build a team, cannot keep a CTO on her team to save her life. It's and doing it all wrong by building multi-feature software, which is competing against massive big corporations with thousands of people. You'd think it's an impossible business, but if you watch how that business is developed, it's developed really well. and she's built something that people use. And if you look at her usage metrics, she had 60% of retail level store employees were using her software on a weekly basis, and 40% of them were using it on a daily basis. And this is without massive motivation from headquarters. This is just on a small trial. So when you see that sort of thing happening, you go, great, this is inside information. There's something here. Let's bet some more money on it. And that's really, but that business isn't unpredictable. The success of that business was unpredictable. Just like when you heard the initial pitch for Facebook, you would have said, hey kid, if you never heard of Friendster, it's over, give up. You need to have the open mind and invest small amounts initially and watch the story over the time so you can take advantage of luck when it occurs. And by the way, many VCs know this. I mean, there's many investors, when they invest in a VC, they say, I don't want to invest in your core fund. I want to invest in your opportunities fund, which does follow-on investments in the best opportunities that have emerged over time from within your portfolio. And some people see those opportunities fund for follow-on investments in the top companies in the VC's portfolio as the best returning. I don't have the data on that, but again, it's the same concept of small amounts up front, watch companies over time, and because you've built up this position, opportunities will systematically emerge.
There's a question which asks that, is there a thumb rule to how much equity you would take at the time of pilot?
No, we have no thumb rule whatsoever. It's just like, I mean, Michael answers this question best. He says, when you're at a poker game, you don't negotiate the ante. Your whole point of the ante. Well, go ahead, Michael. You say it better.
Yeah, no. Yeah, it's not something you ever argue. You sit down and that's the price of admission. It's table stakes. That's where the expression table stakes comes from. So it's just, if you want to participate, that's where you have to get in.
Yeah. So we don't care what percentage we get, just as long. Now we do set a minimum. We share the equity among our advisors. So we take a minimum of 0.1% because we say, look, you have access to a network of 500 advisors. If you were compensating advisors, surely you'd give them at least 0.1%. So we'll take a minimum of 0.1% to be sure we have some equity when the company access to compensate advisors. But we don't make money off the $10,000. We make money on the $200,000, the million follow-ons.
There's another question that we popularly get, from investors, that what stage of the company that you take them when it comes to pilot?
Again, I mean, valuation less than $10 million is the typical rule of thumb. $10,000 buys you 0.1% of the company valued at 10 million. So that's typically the cutoff. We have in some cases taken companies above that. It requires a different process because the company isn't as motivated by the follow-on investment we can give. If the company is growing very quickly, it's harder to get the time and attention from the CEO to build that relationship when it's too far along. So we're busy trying to figure out our processes to be able to do later stage companies. But we got something works and makes money right now where we are. So that's a nice to have project. We can just make lots of money doing what we do today. Perfect. There's a question here from Jose Miguel. Oh yeah, that was how much equity do you take? And you also, the follow-up is, it is hard to value a startup at that stage. How do you value the $10,000? It's interesting. That was a question we got at the beginning before we started this. And I guess both Michael and I are angel investors. And what do angel investors do every time they invest? They negotiate an evaluation. And as an investor, you see tens and over time, hundreds of different deals, and you see what they're valued at. So actually, when we value a startup, we know the standard rules of thumbs. We can share the standard rules of thumbs. We can compare a company to everybody else we've seen who was roughly at that stage. And we have some pretty good ideas on valuation. Now, having said that, as Michael said, we don't negotiate very hard at the $10,000 stage.
We're price takers at that stage. We're price makers for the follow-on, and as Kamal said, we've been founders. We've fallen into inexperienced founder traps of valuing or wanting your valuation too high. That sets you up for more difficulties, higher hurdles in later rounds. So we'll share all of that wisdom, but we won't make the absorption or the execution of that wisdom mandatory for us to make the investment. We want to get in, we want to develop that relationship. And that changes for the follow-on. So there are situations where we'll follow on at a valuation that's less than we started off with at the 10K.
And look, fundamentally, when you invest money based on first meetings with the company, you have no idea what it's really worth. So we'll often tell them, it's like, I don't know what your valuation should be. I will know in 4 months, after working with you for 4 months, whether you gave me a fair valuation or not to start with. But our view is a valuation of a company requires inside knowledge, experience over time to build up. And that's why the 10,000 is a throwaway. The 200,000, we know when we're putting $200,000 in how much the company should be worth, and we can explain in great detail to the company why it should be that valuation, because we're picking the top 2 out of 100 anyway. If a company's valuation expectations are too high, we'll cheer them on. We'll say, good for you, go out there, get the money somewhere else. And by the way, you're not in the top 2 out of 100 in our portfolio because these other ones are giving us a far better valuation. They're at exactly the progress stage that you are, and they're giving us a far better valuation. So we want to make money. We will buy better. We're coming up to the end of the hour. Thank you very much, everyone, for joining in. Thank you for the wonderful questions. And it's been a pleasure to share this time with you. And if anyone is interested in picking up the recording, please do email us. We will have a copy of it that we can share with people as you request it. Thanks very much.